I'll admit it, I'm a numbers geek, and today we're going to look at the numbers of an infinite banking concept. So here's one. I was just working with a gentleman that this is where he was at. He was starting off, he was very interested in infinite banking, and he currently is saving $800 a week in his savings and $1,000 a week he's throwing into an ETF. He's just having fun. He doesn't have no idea what he's doing. So total of that is, if you take $800 a week, it's $41,600 per year. This one again is $100 a week is $5,200 a year. So with this, his available savings was that's $3,900 a month. So what we looked at and what he wanted to do was take $10,000 right now, and then $833 per month after that to get this infinite banking concept rolling. So what that works out to be is $10,000 right now with another that works out to $10,000 in the year. So after the first year is done, he'll have put in $20,000. So I kind of marked that up over here. So we'll come over here to now, like I've said this before, this takes a little bit to get off track or off the ground, okay? So what he was doing, he's taking $800 a week per week and putting that into a savings account, making 0.01%, which is 0.0 nothing. He's going to make zero on it. 0.01% is nothing. So I think I did the math down here. 7 years, he gets. If he took $70,000 and had it in the bank set for 70 years, it would compound all the way up to $7,042 or $70,042. That's great, right? So I'll show you where year one, you've laid out, you put $20,000 of premium into it. Okay, your cumulative premium is $20,000. You're not taking any income yet, but your cash value is only $16,000. So people look at that. I was like, hey, what's up with this? I put 20 grand in. I can only have access to 16. Like, yeah, that's how this thing works, but it takes some time to take off the runway. That's where all the power is taken, is leading this thing off the ground. So you keep doing this, and this policy, the way it was written, the different levers that were pulled, and you can pull all kinds of different levers. And this is kind of just the first illustration. We're going to meet up again and probably pull some different levers. We might change it up, we might not. I don't know. But this is an example, a true real life example. This guy right now is 29 years old. So he's starting early, which awesome for him. I didn't start till I was like a decade older than that. So starting here, what we're doing is first year we're putting $20,000 in. Each year after that, he's putting another $10,000 in, or $833 a month. So that's how that works out. And if he just goes and saves up and does the $10,000 one lump sum per year, it would probably help his numbers out a little bit here. But that's just kind of what we saw in our initial call, the other. So that's where we're at. All right. So year two, you put in 10,000. You've put in a total. You start with your 20 plus your 10. Cumulative, you put in 30,000 total. You're almost there in cash value. You're to 24. Okay. It's not until year 6 where it actually surpasses it. So year 6, you would put a total of $70,000 in. Now we've just went past that of $70,137. Now remember, what he was doing was putting it into a savings account. So here, even if he had the whole $70,000 right now, which it's going to take him 6 years to put all that into this vehicle. If he had $70,000 right now at 0.01% for 6 years, would equal $70,042. Okay, at the rate he's going, which is 0.0 nothing. He would make $42.01 on his $70,000. Over here, now this is where we finally got to our sixth year of putting $70,000 away. It took us 6 years to get there, but now we're at 137. So this is where the paths cross, and from here, so what I did here is in the illustration, it shows every single year, but I don't have much whiteboard. So I took this all the way down to year 10. Again, we're still putting 10,000 in. We've put 110,000 in total. So now this is where it starts to separate a little bit. $110,000 in, your cash value is $128,833. So we're starting to separate ourselves now. So we give ourselves another 10 years. You're still doing 10K a year. We're at a total of 210. Now we're up to 346. Okay, now we're starting to look pretty good. I put 210 into this thing, and it's worth I have access to 346 in cash value. All right, let's keep going. Let's go to year 30. Let's go all the way down to year 40. Year 40, we put $410,000 in. We haven't taken any income yet. We'll get there in a second. I put 410 in cash value is 1.35 million. Okay, now we're looking pretty good. Now, the way this illustration was done, in year 43, started taking some supplemental retirement income. Now, remember, this is saving on top. He's already got his 401k going. He's already got a Roth IRA. He's already got savings, a part of retirement plan already in place. This is basically just fun money, okay? So I think so within this policy, we wrote in from year 43 to 63, when he's 70 to 90 years old, he's going to take an extra $76,582 every year just for extra play money. This comes out tax-free because we're not shutting the policy down. We're just taking a loan against the policy, a loan against our death benefit, and you're going to get an extra $76,582 every year to go have fun with. So starting at age 43, 7 years of that, and also, since we're not taking money out, there's no sense of putting money in anymore. So we've stopped contributing. So we've contributed up until age 43, or I'm sorry, not age 43, year 43, which would be $430,000 is all you're ever going to contribute to this policy with the way this illustration is done. So by year 50, you've put in $430,000. You've taken $612,000 in income, in fun money, just to blow and have a good time, and you still have access to 1.52 million in extra cash value. You have choices here. You have a lot of good choices. You're setting yourself up for success by doing it this way. So that's year 50, 60, year 70, and then at year 70, he'll be 98 years old at this point, okay? So at that point, remember at age 70, which is year 63, we stop taking income. So income goes to 612, 1.3 million. If this whole thing goes as the illustration shows, which obviously it never will, but it's just it's a fun way to look at the future. So year 70 of this policy, this person will be 98 years old. He will have put in $430,000 at starting with $20,000 this year, $10,000 every year until he's 70. He'll have put in $430,000. That's all he'll put in. He will have taken 1.531 million of tax-free loan from this policy. He also has access to another $1.5 million. By the way, if he dies there, icing on the cake, since this is an insurance policy, he's got a $1.78 million death benefit that can go to his beneficiaries if he dies right here. Now, you don't get your cash value and your death benefit. If you were to take if he's 98 years old and he goes and buys a $1.5 million house, now that's going to take this down, so they'll get like $200,000. So it kind of it's advanced against your death benefit is how this basically works. So this, I don't know if you can see this or not, this is basically, with these numbers, is 20% of what he's currently saving. I don't know what he's making. We didn't really get into that. Maybe he could save more, maybe not. But 20% of what he is currently putting away, he wants to put into this policy. And look where it's going to take him. 98 years old. You've put in 430,000. You've taken $1.5 million out and had a party, do whatever you want to do with it, doesn't matter. You can still take another $1.5 million out to do whatever you want to do with it and never worry about paying back. That's it. That's it. This is, yes, it's life insurance. I keep that to the end because as soon as you say life insurance, people are like, oh, I don't want that. But look what it can do. If you put this into savings, you're going to get 0.0 nothing. Now, look, you have choices. Say in 5 years, he wants to buy a car. Say he goes and buys a $20,000 car. You go and borrow against this. This never stops. If you have this in a savings account, you take the savings out and the savings stops making 0.1%. It's not making shit anyway. This is always compounding. It's always growing, always compounding. You don't, what did I say? You're 4 or 5. That money doesn't come out. You take a loan against it. The bank knows if you die, you have a death benefit. And this is not even the death benefit. Cash value, this is just cash value. I didn't put death benefit until the very death benefit is always more. Is always more than your cash value. Okay. But you have choices. If he wants to buy a house, this is why he didn't want to put, this is why he's only putting 20% in, because he's saving up for he wants to buy a house and he's getting married like within the next year or two. So this is short term, so he doesn't want to put it in here and have access to less of it. So he's holding on to that for savings. It's going to be kind of a one-time purchase. It's going to be a down payment and a wedding, and it's done. So that's fine. This isn't always stuff that I would do and not what he would do, what you would do. There's so many different levers you can pull. That's why you need to have your goals. What are your goals? What do you want to do? Do you want let's see, here we're 98, 88, 78, 68. When you're in your retirement years, would you want to look something like this? Where I know in my lifetime, I've put away $430,000 on top of all of my other retirement. You could just make this your retirement. But taking that kind of money, taking $76,000 a year, by the time you're 98, almost 100 years old, you've taken $1.5 million, and you still have access to another $1.5 million. This, once you can get past this magic break-even point right here, then this is the snowball, and it starts going down. You're maybe pushing it uphill a little bit. Maybe you're flat. It starts to flatten out. But man, once you hit that crest and you start going, and it's like it gets steeper and steeper, and down here, this is a snowball rolling down the mountain, folks. So, all right, if you ever want to run your own numbers, text Kyle 855-529-1388, and we can run your situation. How old are you? What are your goals? Do you want to get married, buy a house in the next year? Do you want to set yourself up for retirement? Maybe you want to buy a house? Maybe you want to buy your dream house in 10 years, and you could potentially have access to 128. That's with these numbers. Maybe you can do more than just 10,000. Maybe you start higher than this. When I first started mine, I was 39 years old. I think I started with 30,000 and I put 20,000. I started with 30 and I put 20 per year into it. And what I do then is I take my cash value wherever it's at. I think I'm about 8, but these numbers are completely different. But what I do is I borrow against this. I make a down payment on a rental property, and I bring tenants in. They pay all of my bills, and they bring cash flow in. That cash flow, I shoot right back in here till I repay my loan. And then guess what? I do it again. Now I'm making double the cash flow. I've been doing that, and again, this just helps. This is a snowball rolling down the mountain regardless. Now if you take this and put it towards some investments, some cash flow, or just go have fun with it. You can do whatever you want. That's the beauty. You don't have to I just took a loan out this morning because I had to repay some other stuff. So I literally got online and I said, send me $26,800 or something like that. And it will be in my bank account tomorrow. I had to answer a couple questions because it was this to a divorce decree or something like that. But you don't have to go kiss the ring of a banker. You don't have to go and show, all of your assets. And you don't have to give them, you don't have to give them anything. You don't have to tell them what it's for. If you have cash value, it's in the contract, in the fine print that they have to give you a loan. No ifs, ands, or buts about it. They don't care what you're going to use it for. You can buy a boat, you can buy an RV, you can buy a race car, anything that doesn't make money, you can go ahead and you can do it. Whatever you want. All right, I hope this helps. Again, go ahead and text Kyle to that number if you want to run your situation, and I hope this helps, and let me know if you have any questions. If you do have any questions, throw them in the comments. Like, subscribe, please. I sure would appreciate that. And let's try to get this word out here. This is what the rich, this is what the wealthy do. They don't really talk about it. And insurance agents don't sell this stuff because they don't make any money. Okay? This is all this has to be the right stuff. The agents don't make any money. There's no commissions in this because it's all good for the people that are doing it. So, all right, I'll shut up. Good luck, everybody.